right. So we're back. I'm back.
Strickland.
I'm back. The freight guy.
The freight guy. Back.
The freight guy's back.
Freightonomics, also far away. Freightonomics. We're back.
We're back. So, Anthony, I'm going to be honest, I only watched the first 10 minutes of the show last week. Mainly because I was busy, up in the mountains of Colorado, skiing and watching it snow and watching trucks get stuck on the side of the road.
Yeah.
As it snowed heavily on I-70. I learned a lot.
Market analysis from the mountains.
Yeah, a lot about that. Well, welcome to Freightonomics.
Yeah.
It's good to be back.
Welcome back.
Sort of. I did enjoy skiing.
Yeah.
But this is the show where we combine freight market analysis
and the economy.
And because a lot of people out there really don't have a lot of insight into what's going on in both, we try to bring it together and make it relatable, understandable, figure out what's going on in the economy, how it is impacting the overall freight market, anybody involved in brokerage, trucking, or just transportation in general.
Yeah.
We try to target people that are, on the executive level and the mid-level and the low levels, out there in the weeds, getting it done, as well as the high-level executive that's concerned about the overall direction of the freight market and the economy. And, today's episode is pretty jam-packed.
Yeah, I mean, I know last week was a little bit of a departure from what our series that we're doing. One of the things that I outlined is really something for everyone. And in this series, we're really building up. We're setting down a platform, a foundation of what a lot of the freight basics are and the economic
It's like the how stuff works.
Yeah, exactly.
For the freight market or the freight or transportation in general. I know it took me a while back in the day to kind of get my head around a lot of these concepts. And sometimes you get stuck in these sections and you don't know your section really well, but you don't understand what's going on outside of your little silo or your building or your division. That you have something to do with trucking, transportation, things like that, but you don't necessarily get to see all of it.
Right.
And so this hopefully gets you guys prepared for, encountering just about anything, and also gives you a little bit of a broader economic view, about what's going on in your surrounding market. We all get kind of pigeonholed at time to time. I used to do the same thing. I used to sit there and, think, well, I just need to hit this button here and get this done. But that didn't really do me any good after the first week after I mastered it.
Yeah.
It took me a week to master hitting the button.
Quick learner.
Yeah. And real fast. And then, I would encounter something else that would be confusing. So this week we are going to target the spot market.
Yeah.
Some people may or may not understand what that is. We'll go through that. We'll talk about how it can give you insight into the overall market, how it measures the freight market in general, transportation, the economy even. There's all relations. We're going to have Tom Mallon come on.
No way.
Tom Mallon.
He's not here.
He is. So he's our futures expert.
Yeah.
And he has also been he worked in NYMEX. He's got all sorts of financial market intel.
A true market expert.
Yeah, he is. He's definitely the real thing. From what we're accustomed to here. He worked in the futures exchanges up in New York. He lives in New York.
Yeah.
So he's going to come on here in about 20-ish minutes or so. But first off, we're going to lead you down, what we feel are some of the top stories of the week that are impacting the overall freight market and economy in general. Anthony, we just had the CAS release for the month.
Yeah, and also we're streaming right now, so I'm actively looking. If you see me looking down, I'm looking at the comments on LinkedIn and YouTube. So if you want to chime in, feel free to comment. Mm-hmm. But yeah, Zach, you're back, and we're always going back and forth. I'm a lot of times overly optimistic. And
I'm real.
I'm happy that you're here to bring some joy. So our first topic, our first story.
Yeah, the CAS index release.
The good news. What is it?
It was one of the worst releases in multiple years.
Oh, boy.
But I'm gonna temper this a little bit.
Okay.
So the CAS index, for those that that don't know, this is pretty widely used industry measure in general. It tells you basically how much volume is moving through. They represent about $28 billion of freight spend, and it involves about 50% truckload. The other half is a mix of parcel, intermodal, and LTL.
Yeah.
So they're an invoicing company, and they've turned all these invoices into an index that represent spend, volume, in various levels on multiple fronts. So the shipments index, the one that I think a lot of people are familiar with, this is the one that measures overall freight volume, hit a multi-year low. Is the lowest January since 2017. Now, traditionally, those of you that are familiar with CAS will know that January is traditionally the lowest level that the CAS shipments index hits every single year.
Yeah.
And that's because January is miserable and depressing.
That was one of the first things we jumped off with Freightonomics was how you felt about January. But
I don't like it. But at the same time, this January was the lowest we had since January of 2017. Now, Anthony, can you tell me, was this January better or worse than January of 2017?
I'm going to go with that. This January was worse.
Nope. It was slightly
Look at that.
better.
Look at that.
See, here,
I knew you were going to bring us some good news.
I'm the optimist this
I
week.
knew you were going to bring us some good news. I knew it.
Look at who's the pessimist now. Only slightly better, not even 1% better, but it was better than January of 2017. For those of you that aren't familiar with the freight market in 2017, early part of 2017, we were in sort of a freight recession still. We had some signs that things were recovering in the fourth quarter, just like we do in 2019.
Yeah.
Coming out of a pretty rough year for anybody involved in transportation outside of the shipping side, which probably had a pretty decent year. Although, to our point in general, when transportation isn't having a good year, generally the shipping side isn't having a good year either, because that means they're not shipping as much freight.
Right.
Which means they're not making as much money doing the things that they need to do.
Exactly.
And we'll get into a little bit more of that a little bit later. But the CAS index also tracks expenditures. And expenditures, again, multi-year low, not quite as bad as the CAS shipments. We're looking at about September of 2017 since we hit this point. But the direction doesn't look great. Again, expenditures measures, on average, how much the spend is overall. It's an index. It looks like a rate per mile. It's trending downward, and it took a sharp turn in January. This is more representative of contracted freight spend as well.
Contracted
compared
to spot,
right, which we will get into here shortly.
Yes.
When this is going down, it's representative of bid cycles have come through. Normally you see a lag in this versus the overall freight market. So expenditures trend up for a while, even through like a softening period, because people will accept rates on their bid cycles and they will stay up for a year, because the traditional bid cycle is about 12 months or a year. When shippers say, hey, carriers bid on this freight, they will lock in rates for 12 months. So to get through that cycle and then get downward pressure on rates, again, that's resistant.
Yeah.
So it'll be a little bit longer before rates start to kind of come down like they are right now.
Yeah.
And we just had a full 12 months of softening in the freight market. So it's not that surprising to see this number come back down. It's still not down to where it was in 2016.
Yeah.
Which again, costs have come up. We've covered this in numerous podcasts already.
2016 in the freight industry, that was
it wasn't good.
That was see, there we go.
Yeah, it wasn't good.
Back to the Zach I know.
Yeah, there we go. But yeah, and your industrial economy was a big driver of that.
Yeah. And the industrial economy, was really faltering in 2016, and a lot going into 2020, and a lot throughout the middle to end of 2019.
Right. So, everybody's been talking about the coronavirus.
I haven't heard of it.
Yep. So the coronavirus, for those of you like Anthony who have no idea what this is and have been living under a rock.
Yes.
Or maybe in Iowa. This is a coronavirus is a virus group of viruses, I should say. The SARS virus was a coronavirus. They just didn't have enough time to name it when it blew up over in the Wuhan, which is in the Hubei province of China. It has now impacted lots of Chinese factories. The economy over there is struggling. Again, China, not the most transparent of countries.
Yeah.
It may be a surprise to most people.
Yeah.
Sarcasm.
Yeah.
The Chinese economy is kind of faltering, but also most of our goods come from China.
Yeah, good part of it. Yeah.
A lot of them come from it. Do you know the number on that? What percentage of let's just go with retail.
Retail, I
feel like retail is a pretty strong.
Yeah, it's a big number especially for goods that come from China. I don't know the exact number.
It's going
I
to be
don't
your
want to
Targets, your Walmarts, your, even Home Depots, your furniture. Lots of furniture comes from China.
Yeah, and sometimes there's even processes where we will have the raw material sent over to China,
Exactly.
get assembled, then come back,
Right.
and quite a operation
Yeah,
to get a couch or
it's insane.
furniture put together. Yeah,
It's funny that the cheap labor costs can really drive a lot of that. We have all these raw materials, but we're so expensive. You and I couldn't go and put together a piece of furniture because it's too expensive.
Yeah, it'll take us too long.
Yeah, exactly. I couldn't do it. Don't want to do it really. But as the coronavirus, it seems like it may be plateauing a little bit here in terms of its expansion, but we're not going to see the impact of that in the freight market until here in the next few weeks or so. We shouldn't see that until the initial wave of that, because we had Chinese New Year. We talked about this. If you guys watch any of our FreightWaves media, FreightWaves Nows, On the Spots, any of these, all the podcasts, What the Truck, all that kind of stuff, you're going to have heard about this coronavirus, and you're going to know that we're not really anticipating it hitting the United States freight market for another week or so, at least the initial impact. And a lot of that's still going to be murky because of Chinese New Year.
Yeah.
So, and the reason for that is because it takes about, if they're at their fastest, 12 days to get across the ocean.
Yeah.
Normally it takes about 17 to 21.
Yeah.
Because they make multiple stops, et cetera. But also we had Chinese New Year. The production cycle itself takes another couple of weeks. So there's a lag in impact. So these factories that were shutting down at the end of January are now coming back online, or they were trying to come back online, but nobody could get there because they're all sick or quarantined.
Right. Yeah.
So they can't ramp up.
Yeah.
So this happened in the first week of February.
Yeah.
Again, they go back to their factories, they get settled in, production ramps up, inventory comes online, and then it takes them another while to get it to the port, another little bit to get it across the ocean, et cetera. Well, we track here the Freightos Baltic exchange.
Indeed we do.
Yeah, from China to North America's West Coast. And the rates plummeted this last week. So what do you think that means, Anthony?
I'm guessing there's not as much stuff crossing those seas.
I mean, they dropped off a cliff.
Yeah, that's what I would guess.
It was pretty bad. So again, if you think about, these are spot rates of moving 40-foot containers coming across the ocean. They fell roughly about $150 per container, which again, pretty significant in the overall historical aspect of things. And you don't necessarily see that kind of movement unless there is a dramatic overstatement of rates. The maritime shippers, they set rates at the beginning of the month.
Yeah.
And they actually have set those 30 days in advance.
So
it's not that shocking that they overstate, because they set the February rates beginning of January. So they implemented these rates, and now they are just falling off a cliff because they're thinking everybody's coming back online. Coronavirus back then wasn't a huge thing.
Right.
Coming down pretty strong. So they're trying to incentivize some of these shippers to ship whatever they can across the ocean to fill up those ships. And so what that means, the ports of Los Angeles, Long Beach, the biggest in the United States, New York, New Jersey, again, is going to be 2 weeks after this. So we're seeing some rumblings early on that this may not be a great March, at least for anybody that's shipping these retail shipments. And there is some optimism. There is a little bit of optimism.
I didn't think I'd ever hear you say that.
And in the way that, we're thinking that, and I think our next story of the week, which is Old Dominion earnings, which happened about 11 days ago or so. We got that report. Old Dominion, obviously the biggest, or I guess not the biggest, but the most well-regarded LTL company.
Gold standard.
Yeah, the gold standard, or the platinum standard.
Yeah, we talked about it on our trailer talk, right?
Yes. Of LTL in the country. And they actually talked significantly about, coronavirus maybe hurting this, especially on the industrial economy side. But also they referenced it in the, I think Stiefel also referenced it in their guidance for the second quarter. But they think that maybe this is going to create some sort of bottleneck. And it's going to buckle. So you're going to see this troughing into expansion, like rapid expansion, as everybody gets back to where they're supposed to be, and you're going to see this big bubbling. I personally don't think that's the case,
Mm-hmm.
just because I've watched this type of stuff before.
Yeah.
Whatever production you lose, you typically lose.
Yeah.
We lost we lost power, or I should say connectivity at my old job for 2 days.
Yeah. Yeah.
It didn't come back. Those bills, they went somewhere else.
It wasn't a
It
pent
wasn't
up demand waiting for you guys. No,
They didn't sit there and wait on us to get it back online. It literally just disappeared.
they found something else.
And we never recovered it, and it had a huge impact to the bottom line.
Mm-hmm.
And I think that's what we're dealing with here. It's going to have some sort of lulling, and we just won't get it back.
Okay.
Which, again, you're talking about 1% to 2%.
Mm-hmm.
Not a huge impact, but at the same time, big enough because everybody's
Definitely.
already struggling.
Yeah.
It wouldn't have made a difference in 2018 like it does in 2020.
Right. Where there's a lot more each time you lose a little bit. And
Yeah,
so,
they don't just recover all that stuff. Unless we in America are just, we got to have our LOL surprise dolls or our
we need those.
our oven or whatever that the pressure cookers.
Oh, those ticking time bombs in your kitchen that you just walk by. Yeah.
It doesn't happen. So, but Old Dominion again comes out. This is now this may be your turn to be a little pessimistic because Old Dominion comes out and does what?
They had a drop, and as one of the things that you mentioned was with Old Dominion. One of the things that they cited, I know they cited weak industrial economy, but they also cited the coronavirus, right? And so I think one of the things that you touched on was the impacts from the coronavirus and what that's going to mean for freight. But before jumping into the industrial side, I think on the corona aspect, what we're seeing in China, I think one of the things you mentioned, it's timed out at the same time with the Chinese New Year.
Right.
And so we expect to see that production. I think the other aspect that a lot of people aren't talking about is that during the Chinese New Year, that's also a very big consumption time, right? So for those Chinese consumers, and so
they're not consuming.
They're not consuming, and China's a different country than the United States.
How so?
No. Well, how much time do we have?
No, we don't have enough time.
But one of the things that we see is that they can do things at a state level that isn't happening here on the U.S. on a day-to-day basis, and so they can do certain quarantines, but I think right now what we're seeing in China is self-quarantine. People are scared themselves. The government doesn't have to say don't go outside. They're staying inside preemptively. And so I think we're going to see a lot of a big drop-off in Chinese consumption. And I think we're going to see those when we start to see quarterly reports for maybe those luxury goods that they would typically buy, because as we know, China's grown in the last decade a huge upper middle class. Yeah. So I think we're going to see a big drop off in many of those luxury brands when we see those results for those quarter end.
Now let me ask you this real quick, Anthony. So, and here I'm actually the optimist this time.
Yeah.
Again, so China over the last year, the trade war and all that kind of stuff reduced a ton of imports.
Yeah.
Again, still the biggest importer by a mile, country mile, but still a lot of that sourcing went to Vietnam, Malaysia, India, other things like that we've been tracking. So, we were just starting to get back on track with them with some agricultural, the phase one deal, et cetera, that had not gone into place yet. So is it actually a positive that we had some of this reduction in trade volume with this country? It it softens the blow this year a little bit.
I mean, it could soften the blow, because I think many of those manufacturers or business owners that were already looking for alternatives, maybe they're already kind of like, hey, I got my eyes on South America as a closer, still affordable labor. As you mentioned, Southeast Asia. So I think that may keep pushing, but like you said, it's still a
still huge
partner compared to everyone else, just because they have such resources that there's not going to be able to match
resources.
Yeah, exactly. And so, but yeah, I think when we're looking at China, if they report the numbers, I don't think we're going to see a very large impact coming on from the GDP side. And so, but yeah, on the industrial segment, Old Dominion reporting, the industrial economy has been very weak.
And it's still not showing signs of recovery.
Not showing signs of recovery. And one of most recent data points that showed a little bit of a sign was the ISM PMI, Purchasing Managers
Right.
Index. It popped up over 50 for the first time, I think 5-6 months. That was a
Right.
huge talking point, but there's still a ton of headwind.
And it's also just 1 month.
Just 1 month.
Yeah.
With the trade uncertainty still, the recent developments with the corona, those are all going to present headwinds.
Right.
And the weakness that we saw in the last GDP was a lack of business investment.
Right.
And so when we're not seeing a lot of business investment, we're also not going to see a lot of goods on the manufacturing side that's going to be spurred on by that. And so that's also going to impact freight volumes as well.
Yeah. No, I think you're right. I think it's going to be a pretty we're just going to see this extended period of softness in the overall freight market. Now, our outbound tender volume index, which tracks a bunch of truckload movements, it's very weighted towards truckload. It does not have LTL shipments or parcel like the Cass index does, nor intermodal. Now, it's been relatively positive year over year in terms of overall movement. A lot of that was derived from reefer volume strength.
Yeah.
We have seen that kind of start to fall off, but we're still doing pretty well overall. We do have other things like tank and intermodal. It's in there. It's just not a strong percentage of it.
Yeah.
Some of those things have really started to pick up here in the last week or so, taking up for some of this dry van softness that we're accustomed to seeing this time of year.
Yeah.
What we're really watching for is, some sort of, spring rush. It's
Sure.
typical that in early March that we see this awakening, if you will. The weather warms up, so do shippers.
Yeah. Yeah.
Things start to get moving again. You get more consumption on the retail side. People get out of their houses, start remodeling.
Yeah.
Industrial capital expenditures start getting put into more
Yeah,
use. People are not as leery.
Construction.
Construction is now a thing,
Yeah.
especially in the northern tier of the
Yeah.
states. So we are looking for that. But that being said, it's time to transition into our topic of the week. And
Yeah.
this is a decent. It's not a great segue, but this is
Top
a
5.
yeah. This is as we're watching this softness in the market.
Yeah.
The spot market itself has given us a little bit of optimism. Myself, it's given me a little bit of optimism.
You've said optimism 4 times.
A lot.
And I'm shook.
You set me up pretty good. And we're gonna have Tom Mallon come
Yeah.
in when he's ready here in a few minutes, and he is our futures expert. He's
Yeah.
going to help us kind of illustrate what he's seen. He's not a freight person in general. He's learned a lot over the last 2 years working at FreightWaves, but at the same time, it'll be interesting to see his perspective on what he thinks about the spot market
Right.
and this in the transportation sector versus other sectors that he's worked in, of course. So the spot market itself. Do we know what the spot market is, Anthony?
Zach, there's a spot market and there's a contract market, right?
Right.
Well, I'm guessing when there's a contract market, I sign it's like an agreement, right? That I'm going to do this service that we both agreed to and for the set price, and that it's not going to be broken, right?
In a sense, yes. That's what normal contracts do.
In normal contracts,
Yeah.
but freight should be no different.
Well-
Surely.
Well, it's not 100% that way.
Oh boy.
So the spot market itself, of course, is transactions that occur outside of a normally agreed to proposition.
Yeah.
So a shipper such as Target will go to, Knight Swift and say, "Hey, Los Angeles to Dallas, we're going to do this for $1.65 a mile. You guys agree to this? You agree to it? Sure." All that means is if Knight Swift accepts that load and says, on that day for the next 12 months, anytime that Target sends Knight Swift a load going from Los Angeles to Dallas,
Yeah.
they will carry that freight for that $1.65 a mile plus a fuel surcharge or whatever it is they agreed to. Now, sometimes what happens is, Target has a lane pop up that isn't on their normal routing. It's somewhere Redding, California
Yeah.
to St. George, Utah.
Yeah.
They didn't set an agreement to that.
Yeah.
So what they'll do is they'll call Knight Swift up and say, "Hey, can you cover this?" That's outside the contractual agreement. But sometimes Knight Swift is like, "No, that's not under our agreement.
Yeah.
We can't cover it anyway because we're not set up to do it." That's, again, Target has multiple carriers, but for simplicity's sake, I'm going to just say that Target now doesn't have a carrier to cover this load. they then go into the spot market. And the spot market is this, kind of amorphous being. It's basically where they call up or they put out a load on their load board. They have a load board, but they also could go out to any of the load boards, truckstop.com, DAT, et cetera. There's numerous load boards out there, but they then put it into the internet and say, hey, bid on this.
Yeah.
And all these brokers will jump in and say, I've got a carrier that'll do it for $2.10 a mile, $2.05 a mile, da 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 da. And once Target is satisfied, they will then accept whichever service and rate combination that pleases them the most.
Yeah.
It could be carriers, could be brokers that are handling it. And so that rate is then logged into the spot market. It's normally, it can be below the contracted market. It can be higher than the contracted market. Gotcha. It just depends on the market conditions. In that instance, it's probably going to be higher than the contracted market because it's outside of it's an irregular route, if you will.
Yeah.
A lot of what we track here is the regular routes, Los Angeles to Dallas, Seattle to Los Angeles, Chicago to Atlanta, these major lanes, these thoroughfares, lots of traffic. Spot market during this time of period generally operates below contract rates.
Gotcha.
Just because you get there's just not enough volume, carriers are desperate for capacity, et cetera. And they are, it just drops below the contracted market.
Right.
So, and that's also below cost a lot of times.
So, Zach, there's a spot. We've established that.
Yep.
There's a contract. Does one lead the other?
So, this is a great question, Anthony. It's almost like you thought about it.
No. This is all new to me.
Yeah. So, the spot market drags the
Yeah.
contracted market
Gotcha.
in the direction that it is going in.
Gotcha.
We talked about this, I think I talked about this a few weeks ago, or at least a month ago, where we watched spot rates, national average spot rates. They were the two peaks last year. So you normally have a June peak and you normally have a December-ish peak.
Yeah.
When the June peak is lower than the December peak that year, that's a direction that's showing you directionally that the market is going higher.
Gotcha.
So rates are going higher than they were. Again, if you're looking at that peak inverse, June is higher than December, the direction is lower.
Okay.
So that means that the market is softening. We saw tremendous softening in 2019 or 2018 into 2019. That direction, the June peak in 2018 was way higher.
Yeah.
You're talking like 15, 20% higher.
The June peak for the
2018 year.
spot rates?
Yes, for spot rates. Yes, we are talking spot rates. And what has happened is all those contracts that were higher last year now got dragged down. You got to see those rates come back down.
Yeah.
So a lot of the times that spot market activity, which again is a good indication of overall supply demand. Do you know how much of the overall freight market is operated in the spot market? Truckload.
Would it be anywhere from, I don't know, 60%, 70%?
No, not even close.
How much?
It's about 15 to 20% on average.
Oh, wow.
Yeah.
So majority of it's contract.
Majority is contract.
Look at that.
Yeah. And that's because shippers don't want to go out there and have to freely source all their transportation every day.
Yeah.
It's a lot of extra work.
Yeah.
It's not efficient. That's not their jobs either. Like they're out there making goods, providing services, et cetera. And so the idea here is that the spot market is going to tell you exactly what's going on underneath that in the contracted market. When it is going higher, that means contracted rates are bumping up. There's Tom Mallon. He can come in now.
Tom here.
Yeah, Tommy Mallon.
Tom is not really.
This is a great time to introduce Tom Mallon.
Oh my goodness.
So
the man himself.
Yes.
Tom Mallon.
Tom Mallon, put on some headphones here. We are talking about the spot and contract market and how the spot market really leads contracted freight pricing. So, but Tom, first off, you're our futures expert, freight futures. Give a little background on yourself. Tell us, where you've been, what you've been doing.
Sure.
Life.
So, my life. Yeah. So I've been involved in the financial markets for over 30 years.
Yep.
Started my career at an exchange, the NYMEX, which is a futures exchange, which is now owned by the CME Group. My primary focus there was strategy, and the contracts traded were energy.
There we go.
And so, and metals were also traded. So I was there for 13 years, developed a number of different markets electronically for the trading of futures. And then I moved to the data side of the world. And so I ran commodity.
One of my favorites.
Yeah, commodity data businesses at Thomson Reuters, at a company called Interactive Data, and then most recently a company called Global View. Okay. And then I moved to FreightWaves because of futures.
Right.
So really excited about the prospects. It's a brand new market. There's never been anything like this for freight, and so really good.
Yeah. So, we were talking about how the spot market tends to lead the contracted market. It pulls. It has a push-pull effect. This happens in other industries, correct? How the spot market can kind of pull up the costs and prices. Depending on the activity, how long it stays there, et cetera.
And so for any market, there has to be an underlying spot price.
Right. Because not everything can be accounted for.
That's correct.
Yeah, you can't possibly see when you start your year or your day or whatever it is you're doing. You can't possibly see all the variables and everything that's happening in that market. And specifically in transportation, shippers out there, they know that they shipped 4,000 shipments last year. Maybe this year there's going to be 4,500. Maybe it's going to be 3,800. They're going to tell their carriers, we had 4,000 last year. That's all we can tell you.
Yeah.
And it's going to be in these lanes. Things happen, things change that you do not plan for. Anybody that's made a budget knows that budgets fail every single year because you don't have a crystal ball. It doesn't work that way. And so in those instances, that's why there is this overflow and underflow, if you will, of spot market activity in just about any industry that you see. And would that be accurate?
Yeah, absolutely. I mean, markets are generally driven by supply and demand,
right?
Which creates the ebb and flow of price that you were just describing, or loads,
right?
And that gets reflected in the underlying markets,
right?
And that's where futures come in, because it can help manage, that ebb and flow of price, right, or volatility. And so, but the underlying spot price is what gets represented in the futures on a forward curve.
Right. And the forward curve, of course, is the, every month's potential price.
That's correct.
That goes out to 16 months.
16 months. So what it represents is the market's view today of what a price could be in the future.
Right. So the participants think that it's going to go from, it's $1.65 this month on average. And then in December next year, they're thinking it's going to be $1.81 per mile on average. So this is a good way, it's a good tool for people to use to, essentially say, you know what, I budgeted for $1.81 and I'm okay with that. If you're a shipper, you could be like, okay, I'm going to lock this in. I'm going to say this is going to be $1.81 in December, at least at this amount of mileage, et cetera. And again, we don't know what's going to happen next year.
Right.
But we've been in a very flat period of time, correct?
Yes. I mean, if you look at the forward curve today,
yeah.
I mean, we're sitting in a spot price of about $1.39 nationally. You look at the forward curve going out 16 months. 16 months from now, the curve is $1.42. So you're talking about, a 3 cent swing 16 months out, but along the curve, you've got a 15 cent upward spike. Middle of this year's what the forward curve is looking like.
Yep.
And then towards the back end, it's back down to $1.40.
Wow, that's fascinating.
Yeah.
So people are expecting a pretty big second quarter peak. Again, if you go by that, then you're going to see, basically a nice summer session, and then we're going to go back directionally almost downward, which is fascinating to me because I think most analysts out there are projecting the market to basically have this slow upward progression. I myself think that we're going to have, a little bit better second quarter than the first quarter, but I think by the second half of the year, I think we're going to start to see things ramp up a little bit more. We're going to have some election results that are going to come in, and you're going to see that have an impact overall. But I also think there is a pent-up demand. There's a lot of pent-up energy in the overall economy. Now, we were just talking about coronavirus and its impact to this first half of the year. We think it may have actually delayed some of that onset.
Yep.
You know, Stiefel and people like Ravi Shankar have projected that this is going to have a bit of a bubbling effect on the economy. There's going to be a lull here early, and then there's going to be this big recovery session. I don't know if you can recover all of it.
And I think you're seeing, actually, you see that reflected in the forward curve,
Right.
where you're looking at, very soft rates into the April-May timeframe before you start to see an upswing in rates into the summertime.
Right.
A little bit of lull again into the third quarter, but
Right.
then holiday season kicks in, and you see the curve ramp up again. So I think that's reflected in the curve. And the other thing with the curve you have to remember too is it's a sentiment. It's a reflection of sentiment
Right.
at a given point in time. And the curve does change on a daily basis because pricing information, fundamental information, make its way into the market. And what you've seen actually over the last 3 months is the curve actually has shifted higher.
So there is a little bit of optimism.
So there is
I'm all about
optimism.
it.
Well, I guess maybe an optimism for the carrier.
Yeah.
And maybe the broker a little bit, not necessarily the shipper.
Yeah, yeah.
The shipper does I think the shipper realizes at times they are definitely getting a trough, like we're seeing now, but those don't last. And I think that something that we can all get kind of lulled into is this false sense of security. And the longer that we were in a flat situation, I've seen it numerous times before, the longer you're in a stable environment, the harder it is when it breaks out.
Yep.
You've probably seen this
Oh,
numerous
no,
times.
absolutely. And I think when you look at where we're at today with rates, I mean, if you go back to the first trade of trucking freight futures, the first contract traded at $1.34 a mile. We're sitting at $1.39 today.
Still higher.
So, yeah, but we're a little bit higher. So you look at like where is the floor? I mean, we got to be very close to the floor. And if you look at the curve, there is no point on the curve going 16 months forward that's lower than where we're at today.
Oh, wow.
So there's definitely optimism.
Look at that. Or skepticism at that, depending on who you are. So, I think that's quite telling, especially, again, we're talking about the spot market today and how much it pulls up rates. So maybe there's people out there that say, well, I don't operate on the spot market. Well, you probably do. You just don't realize maybe you're calling a carrier, et cetera. But there will be a day where that carrier that you rely on in your first or second position does not show up.
Right.
It happened to me.
Yeah.
We were a carrier,
Yeah.
and I sure didn't trust the carriers.
Yeah.
I was in an LTL space for 15 years, and we had a line haul department. We outsourced, so we were effectively a shipper. And there were numerous times where the carriers literally just didn't show up. And of course, the more niche the carrier is, reefer, flatbed, et cetera, they are they're more volatile because there's less of them. And they won't, there's less of them, so that means that there's a chance that they won't show up as much. And then that's when you enter the spot market. And the more times that happens, the higher the spot market rate goes.
Yeah.
Because all these people are simultaneously calling each other. And the carriers are out there saying, well, I can go get this rate over here now. I'm going to cover this first because they're giving me $1.40 a mile. I was only getting $1.38 over here. And so the pattern repeats and repeats. And the more that you get that, the higher the contract rate eventually goes, especially if it stays elevated beyond the peaks of your June and your December peak levels. That will pull up your contracted accounts. And we are seeing signs that everybody generally thinks that by the end of the year, we're going to have a stronger back half of 2020 than, looking at the futures market. They're thinking that we will, correct?
Yep.
And looking at some of our data, we think we will. There's just these little hurdles. Again, we don't know. But there's these little hurdles that are showing up here in the early part of the year, especially revolving around China. Will it be a game changer?
Yeah.
I don't think it'll be any long-term game changer because they're already plateauing on all that kind of stuff. But we need that industrial economy, Anthony Smith.
Yeah. The industrial segment's really going to be an area that I think that's going to be watched closely over the second half of 2020 and definitely during the mid part. But yeah, it's really been a lagging component. We've really been leaning heavily on the consumer, especially towards the latter half of 2019. The first parts of 2020 so far, they've held up. Consumer confidence is still pretty high despite numerous headlines. We have new consumer confidence numbers, I think, coming out next Monday, sometime next week, early next week, I believe.
Right.
Last set of survey data points, it didn't really fully, I think, capture the latest from the sonar. So this is going to be interesting to see how impacted consumers are feeling from all the concerns around the coronavirus. Is this going to be a small blip, as many other things that were expected to impact consumers, and they're just going to keep chugging along like nothing ever happened and take this one to the chin and just keep,
Americans are resilient, I think.
They are. They are.
I mean, we're so jaded in America. Now, I don't think that other parts of the world are as resilient in terms of, I don't know if I'd call it resilient, as it would be oblivious to certain things. But Tom, what do you think about, do you think coronavirus is going to have any lasting impacts into what you see? I mean, we're seeing it. It's not really affecting.
I mean, you're seeing it today. I mean, it is definitely reflected, at least short term. The futures markets over the last 2 weeks have been, trending lower.
Right. So that's not just like next month's going to be lower. You're talking about like next month's lower, but it may be like lower than people are trading it down.
It's being it's being offered down.
Yeah.
And so and that's directly related to the coronavirus. And that's what market participants are telling me.
Yeah.
And so I think over the short term, we're going to continue to see that. But again, the futures forward curve, it turns optimistic.
Yep.
In 6 weeks or so time frame, it turns optimistic again.
See, that's fascinating because we can actually see, and the good thing about futures markets is they kind of tell you what a lot of people are thinking. You're basically getting a lot of other.
Well, it's a consensus.
Yes.
I mean, at the end of the day, it's a market.
It's like a survey.
It's consensus, and the consensus changes. It can change daily. It'll change weekly. But it is a market view,
and it is
on rates.
And it is it's stronger than just simply a survey. I shouldn't have said that, but it's basically where people are putting their money.
Yes, exactly.
They're putting their money on it.
Yeah.
So that's a stronger value in terms of overall market sentiment.
Exactly, and that is one of the core benefits of a futures market, is not only the ability to manage exposure, but to have a view on where rates potentially could go out into the future.
Yeah. So that sums it up. I mean, the spot market itself is, a good measure of where the overall freight economy is moving, what's happening on trucking, et cetera. We're obviously in kind of a lull, a trough. January, February, not my favorite months. Anthony loves them.
Start to a new year.
But we don't expect any real short-term recovery. Coronavirus looks like it's going to have an impact to first half results. We should check that out. We'll talk about that later. But Anthony, do we have any other economic results over the last week or so?
Boy, do we.
Oh,
mean, there's a few things.
Give the people what they need, some optimism.
All right. So there's one thing. It's concerning.
Maybe not. Maybe I'm the one that needs to talk.
Perhaps. So one of the things I think we touched on end of 2019, I know during our monthly webinars or in our Sonar monthly market updates and things like that, was the state of the consumer. And because consumers feeling so confident, the thing that we have to be really watchful and kind of mindful of is their spending, because they're feeling confident. Jobs security is very high right now. Confidence in that. We see the quit rate is still pretty elevated. Consumers are feeling confident in finding new roles. Unemployment levels at historical lows. Participation rate is getting up there. It's still kind of low, but getting up there.
Right.
But they're spending, and discretionary income hasn't quite grown at that same rate. And so
little credit action happening.
Some credit action is happening.
Because everybody's overconfident. This happens every single time.
Yeah.
Once you have too much time between recessions,
Yeah.
everybody gets excited. They're like overconfident in their ability to spend and have money, et cetera. And so we're starting to see that kind of bubble grow again.
We see some debt. So debt kind of surged up lately. So the latest numbers from the Federal Reserve shows that debt surged in 2019 overall, and that household debt increased by $601 billion in 2019, so now totaling $14.2 trillion roughly. So this is the largest annual increase since...
Don't say it.
2007.
Oh.
Yeah, I said it. So the other big part of this is that a lot of that debt, I don't know if you want to guess what it was fueled by.
Housing?
Mortgages.
Yeah.
Okay, the doomsday music, but that's okay. So the big part is that delinquency rates are much lower, and we have different practices in place. So a lot more regulations behind this scenario.
So you can't go out and like do the Big Short.
Yeah.
On the housing market.
No.
Find all those bad mortgage loans out there sitting buried in some of the better mortgage loans and then sell them off. Go watch The Big Short if you want to know what I'm talking about.
Yeah.
It's a fantastic movie.
A lot different environment now. So
it explains the 2007, 2008 housing market crisis.
Is it on Netflix?
I don't know.
It used to be on Netflix, I think.
Should be.
Yeah, I think it was on
great.
Netflix. Might still be.
Yeah.
But that's going to be a concerning area to watch.
Yeah.
But the good thing is that delinquency rates are low. Other thing is when you're looking at unemployment rates and you're looking at these job reports, the thing to be mindful of is the quality of those jobs. As one of the other things we talked about in 2019, are these going to be high-paying jobs that are going to be able to support consumer spending? And is there going to be a lot leaning on consumer credit? And that's one of the things that we were worried about, and this is what we're seeing now. So the good thing is that we're not seeing those consumer delinquency rates skyrocketing or rising. So that's going to be something to watch closely. But when a consumer is feeling confident, they're spending more, that means more freight is going throughout the country. And that means more spending on goods and services. So that means more economic growth. That means more expansion, especially as we're seeing a lot of a slowdown on the manufacturing segment overall. Right. Also, the Fannie Mae, the good folks at Fannie Mae, they put out the Home Purchase Sentiment Index.
Oh, man. All those feelings.
I love it. I love the feelings.
Anthony loves feelings. I like to just see what's happening.
Yeah.
Give me the facts.
We put it together, and it's a nice pairing. So I'm going to pair this one together. That Home Purchase Sentiment Index, it's been rising. It's still strong. So that's hints, it signals that consumers are still feeling confident about purchasing a house.
Overconfident?
I wouldn't say overconfident. They're feeling strongly. They're feeling strongly about buying a house. They want to buy a house, primarily entry-level homes. So for folks like Zach, the data behind it, housing starts are still strong. So housing starts end of the year, very strong. I think near a 12, 13-year high. So that was a great thing to see.
So they are putting their money where their mouth is.
They are. So it's a good thing to see. So we expect to see this to really kind of persist throughout the year, especially into spring. The latest numbers for housing starts were around about 3-point-something% decline this last month. That came out this morning. Not surprising after such a strong month last month.
Right.
So we're still optimistic because those numbers are still very impressive. That's going to lead to more construction spending. Again, those consumers fill those new homes with stuff, more activity for van and flatbed for those building materials. So yeah, as I mentioned earlier, we already kind of touched on the industrial segment, industrial economy not doing well. We just had the latest numbers from industrial production, did not impress at all.
No.
And so yeah, we're going to be watching that one closely, but I really don't expect that one to really come online anytime soon in the next month or so. But I think by the end of the second quarter, we might start to see some upward momentum building there. All
right. So reasons for optimism from Anthony Smith.
Yes.
You can't just tell us that everything's, credit bubbles and stuff like that are, nothing to worry about. Never had those before.
No.
So, that about wraps things up for this week. But we do have one more thing to cover. Okay. Now, Walmart just came out with some disappointing earnings.
Yes.
Walmart, one of the biggest shippers in the United States, responsible for tons of freight movements on their own fleet as well as other people's fleets. And, again, they did have year-over-year growth, just a little bit lower than, analyst estimates. You've probably dealt with analysts before on this regard. I personally have trouble with some of these because they're based on, feelings in general. And I'm not one to think about forecasting in terms of feelings. I like to see actual numbers that show me direction, just like we were talking about with the spot market. So they did have some growth. It wasn't as robust as everybody expected. Wah wah. But Walmart itself is a behemoth.
Yeah.
I mean, it controls a lot of retail spending. But the debate we had, we had this several months ago. We had this several months ago was, Target is also a large shipper.
Yeah, I enjoy Target.
Yeah, and Target is, again, retail giant.
Yeah.
So there is some data behind this that I want to talk about a little bit.
Please.
In the way that, Walmart, we talked about Walmart or Target. Mm-hmm. Which one is more recession proof?
Walmart. Was that a question? Walmart.
So why?
Because they usually offer a much lower price point, larger. Mm-hmm. Also, they're not getting kicked out of Canada. There's another one. Okay. I love Target, but I don't think they'll be able to compete with Walmart on pricing, especially on the grocery section, although they are growing. I've done some grocery shopping at Target. But I think when we're seeing any kind of impact on the consumer side, say those delinquency rates start getting a little bit up there, confidence level starts dropping, they don't have that disposable income anymore, they're not feeling as confident, I'm going to Walmart over Target for the better deals.
Oh, Tom, do you have an opinion on this one?
I am a Walmart guy as well, so and not so much a Target guy.
Yeah, I mean, I enjoy Target. I love going in there. They have some of the best shopping carts in the game, one. And then I like going in there smelling that fresh popcorn.
Dude,
I've never even had
the Target
popcorn.
shopping carts are way superior. Don't do that.
Oh yeah, they are. I love the Target shopping carts.
No, Target shopping carts are way superior.
Oh yeah.
Oh, I thought you said Walmart.
No. The Target shopping carts. Some of the best shopping carts in the game. They're smooth almost every time. I want one at home.
So if you notice, there's a common link between what's going on in this room right here. What do we all have in common?
We're market experts.
We're men. We're men. There's no women in here.
Yeah.
And this is why I feel like Target is still, it's like the cockroach of the nuclear holocaust.
Oh, goodness.
There is no way that my wife will stop going to Target ever.
Okay.
And having been in Walmarts and enjoyed the people of Walmart numerous times, I know, I know for a fact that there are enough of these women out there, they will not let Target die, and they will go down fighting. I don't care if they have to put all their money on their credit card, just like we were talking about a minute ago with the housing. Yeah. That credit bubble will go to infinity as long as they can get into that Target. Now, there is a little bit of me that it's coming around a little bit more because what you said about the grocery side of Walmart is actually growing quite well.
Yeah.
Target's got that food too.
They do. But my favorite food, not even a big, is the popcorn.
Yep.
I love the popcorn smell. But I do think Target loyalty. That's the thing. It's real.
It's real.
It's real. I enjoy going to Target. Sometimes I can get the same item at Target as I can at Walmart. I just feel better spending an extra 60, 70 cents on Target. I'm like, yeah, I got it from Target. What? That's. But if times are tight, I'm going to Walmart. And then if times are even tighter and there's something that I usually get at Target, I might open up the old smartphone, activate that Amazon Prime.
See, you are totally hedged. In any spending environment, you are totally hedged.
It all comes back around.
Yeah, Amazon. Now Amazon has the Amazon Essentials. You can get Amazon socks. They have clothes now.
You know what? It doesn't even matter. You know who we need to ask about this? 14-year-old girls. Because they drive the economy and we know
world.
This. Yes,
they run the world. On that.
I'm going to go ask my daughter, who's 10 now. She's starting to be in that demographic.
Please have her write up a report.
I'm going to ask her. I was like, Target or Walmart, Daddy, and we're going to make it happen.
Yeah.
All right.
They run the world.
All right. Well, that will do it for this week's Freightonomics.
Wow.
So hopefully everybody enjoyed it. Again,
Yeah.
thanks for watching on LinkedIn.
Shout out to our production team too.
Yeah.
The intern Imola running the show and everything.
Making it happen. Thank you,
Connor out
Tom,
there.
for joining us this
Thank you
week.
for having me.
Yeah, this is a great show. So everybody have a great week and tune in next week, 2 p.m. on
Yeah.
Wednesdays, Eastern Time. Of
Yeah.
course, we're getting close to that time change.
Yeah,
so,
yeah.
Anthony,
Zach.
I'll see you here in a bit.
Wow, thanks for joining us.
Tom Mallon, bringing the spot out.
Target versus Walmart.
Walmart versus Target.
Versus
Target's going to win.
Versus my phone.
Exactly. Exactly. That's going to be